Hello there. You are tuning in to the Wild Bat podcast. This is episode 13. We're almost finished the Income Tax and CCPC course. As per the slide, this is module 10, where we're going to look at owner-manager remuneration, salaries and dividends. So there is this discussion of which is better to distribute at the year end. Either distribute some salaries via a T4A. I wouldn't suggest doing a T4 unless it's a small amount, usually about 2,000. Any more than I think it's 3,000, you have to actually file payroll remittances on a regular basis. Or you can declare a dividend at the year end. Let's look at the comparatives between what you do at the year end. What usually happens, before we go into that though, is when you're doing the accounts, generally a small business will not necessarily do anything. They won't be set up for payroll and they won't be giving themselves a wage. When they make money and they have cash in the bank, if they need it personally, they will withdraw this and use it personally. Now, there's nothing wrong with that. In Canada, you can, if you've deposited money into your corporation's bank account personally, it gets recognised as a shareholder loan. A shareholder loan that the corporation owes to the shareholder. And as a result, the shareholder can withdraw this money at any time, providing that the corporation has enough money for its own operating expenses. However, as the corporation makes money and has a profitable enterprise, what happens is then there's excess cash in which the owner, who's effectively an employee, spending time, not working anywhere else in lots of cases, is not getting paid and needing money personally, and will draw money from the corporation in the sense of drawings. At the end of the year, we have to determine how to treat this, because the owner has to pay tax personally. When it comes to drawings in Canada, what happens is if you draw more than you have a shareholder loan available that's from the corporation owing to the shareholder, what happens is then it flips. The liability in the corporation becomes an asset. And because of that, it becomes a shareholder loan asset. A shareholder loan asset cannot subsist on the balance sheet of a corporation for more than 2 years. Otherwise, the shareholder has to recognize this as income. So it's better off we declare it as a dividend or create some salaries to reduce this amount. So let's compare the two. We have salaries here. If you want to declare this, I'd suggest a T4A, a big bonus at the end of the year. Or you could do regular remittances throughout the year, where every fortnight or month you give a drawing in which payroll remittances are taken out, federal tax is deducted, CCP, EI, all of that. CPP. Yes, CPP. And the difference, and however, you could also declare a dividend. There's no remittances with the dividend. You can calculate this at the end of the year and declare it via a T5, and it could either be eligible or not eligible depending on if you have any grip in the account. They get treated differently in the tax on the personal side, where they get grossed up and there's a dividend tax credit. You might want to go back to module 3, where we talk about integration. The other difference, however, when on the corporate side, when it comes to taxation, is salaries get reduces the corporate taxable income. This is an allowable deduction in which is recognized as an allowable deduction to reduce the taxable income, and hence there will be less tax to pay in the corporation. This does not happen if you declare a dividend. Dividends are distributed post-tax. However, you can be more flexible with a dividend and when to declare it. Bonuses, the T4A, you can do it as well, but dividends are a little bit more flexible in that regard. Right, I'm going to shoot over to Excel now, where I'm going to just show a worksheet of the comparatives. Okay, I created this basic worksheet. It doesn't go into an extreme level of detail, comparing dividends versus salary, where I've got salary on column D and dividends on column E. We can change the salary amount here and the dividend amount here in order to alter the scenario. So looking at this scenario here, we have 250,000 are going to be equal across both scenarios to make everything align, so we have a good comparison. We go down, we can add a salary in here. I've added 250,000 here, but if we're going to change this to 100,000 or more than that, 10,000, we're going to see here that the corporation has to pay corporate tax with the small business deduction allowed because it's less than 500,000, as well as that it has a lesser taxable income. Compare this to the dividend scenario over here, where they're paying corporate tax on the entire amount. This also includes Alberta tax. Going down here, on the personal side, we have salary as well as any grossed up dividend over here. Now this is where it gets a little bit more tricky. The personal taxes are paid in brackets. The first 49,000 is paid at 25%, which is the personal, both federal and Alberta tax combined. 15% plus 10% Alberta. Going down, there are changes as we go, as we increase the income brackets. The formulas look a little bit complicated. I want to point out that in any tax program, which I tried to compare to, there are a lot of inputs and outputs. There's tax-free amounts such as the general rate. There are general deductions and initial amounts that you get to claim, climate action initiatives, and so on. However, up here, I've determined that under this scenario here, if the dividends declared are reduced by the gross up to make the grossed up dividends equal to salary, then it becomes almost a line where you're paying just a little bit more in total taxes down here. Obviously, there's more inputs and outputs, which is going to change this number, which the spreadsheet doesn't cover. However, let's just change the scenario a little bit. We'll make it only 100,000 here. With 100,000 salary incurring, we have similar, and 100,000 earnings, 100,000 salary, we have no tax paid corporately, and then we go down here and there's tax paid personally, which is similar in the dividend scenario. So we'll just leave this here. We'll just say this is going to be 100,000 here. Here it changes again because of the gross up with the dividend tax credit, which it can get complicated with the Alberta tax credit as well, which I've added in here. But there's a lot of ins and outs. And on the tax return program, it will go through all of this. It's like a big calculator that's already set. If we get rid of the salary completely and we just pay tax corporately, as you can see, we don't pay any taxes. Now this is because the corporate rate is at a much lower rate than if it was personally. But note that although the corporation has to pay tax and pays less, it has to be distributed to the shareholders at some point, so there is going to be a tax impact. Another key thing I like to do when looking at these brackets here is I try and determine what the tax is at the bracket. So we look at the income, and if it is going to be that, $80,000 or whatever, we'll just say 80,000. We know that the first bracket is going to be taxed at a full amount, being $12,255.25. And let's forget about all the other deductions and grants and benefits that may be incurred on the T1 tax return. The second portion is the excess of the income over the first tax bracket in this scenario. However, if we change it up again and make it over that $98,040, which is the upper limit of the second tax bracket, we see that the second tax bracket is fully taxed, and then the remainder portion is taxed at the third bracket. There are other factors beyond just taxation, the amount of tax to pay when you are thinking about if to take out salaries or dividends. If you have a perfectly integrated system, it will be indifferent. Sometimes the tax regime and the tax situation you have doesn't result in that, so you can use worksheets and play with tax returns to try and figure out the best scenario. Another factor that has come up, which I'd experienced with my clients, was that the certain COVID benefits have subsidies. Salaries have been generous subsidies from the government. We're talking, temporary wage subsidy, the Canadian Emergency Relief benefit, which is a loan in which you can take out only if you have a payroll account. A lot of clients had no payroll account. They were just having this dividend set up where they would declare a dividend every year from their corporation, and as a result, they weren't actually eligible for the CEBA. It does depend on what dividend it does depend on how much income is in your corporation. If you have income that exceeds the small business deduction, it may be better to declare them as dividends instead of having a salary. But a salary can also reduce your income to mean that you do get that small business deduction. You get less of the small business deduction, so you can allocate more and not have to pay any tax in your corporation in excess of the small business deduction. It depends on how much refundable dividend on hand pool you have, or general rate income pool is available in the company. If these are available, you will wish to declare a dividend. Another big example, and probably the biggest factor in my opinion, is if you as a taxpayer or you as your client have personal cash flow issues. If they are struggling to make payments on their personal taxes, if they're delinquent, it is better off that they are on a salary in which they are getting paid every month on a periodic basis, making payroll remittances, so that when it comes to the end of the year, then they won't have a big nasty personal tax bill in which they will be late on and interest and penalties. That would probably be the biggest one in my opinion. I see this a lot, and it does break my heart when I see my clients struggling to pay their taxes and having to get interest and penalties on this situation. Alright, bit of a short one, but that was all for this one. I will be doing Module 11 very soon, which we are going to be looking at Part 2 of the owner and management remuneration. It is going to look at salary and bonus issues. Alright, thank you.